Good day to all the participants in today's webinar, hosted by Minet in association with Aon, our global partner. My name is Doreen and I'll be your moderator for the session today. You're all welcome. Thank you for joining us today as we discuss managing volatility in turbulent times. We all know that in today's economy, it is becoming harder to run a financial institution because of the pressures to increase the top line revenues, to maintain the necessary capital ratios, and to also maintain a healthy balance sheet. And again, combined with offering our clients the best services with the best digital solution. We know that COVID-19 has accelerated the fourth industrial revolution with expanding the digitalization of human interaction, e-commerce, and now businesses must rethink their risk management. That means that for all businesses, they must realign to the new operating environment. And we know that that comes with a lot of risks and challenges. Today, we'll be listening to experts from Aon London who will be speaking to us about a number of issues. Today, they'll be talking to us about the key risks facing financial institutions, things like digitalization, operational resilience. They'll also be talking to us about how to manage risk through mitigation and insight. They'll also expound on risk transfer and insurance products. I'd like to briefly welcome our panelists today. We have 6 experts who are all experts in their specialties. We have Daniel Butler, we have Paul Nicholas, we have Justin Clark-Salt, we have Duane Folkard, we have Adam Wena, we have Lizzie Broad. All these are experts in risk management in their different specialties. Please note that today's webinar will run for 1 hour with a 10 minutes question and answer at the end. Please submit your questions through the question and answer chat box. If we don't have sufficient time to answer the questions, we will definitely get through to you at the end of the webinar and engage with you privately. We hope that you'll find this discussion very insightful and thought-provoking, and you'll manage in terms of managing risk for your different institutions. Thank you again for joining us. And for those that submitted questions pre-webinar, we took note of them and the panelists will be discussing with them during the course of the session. Without wasting any time, I'd like to invite our first panelist, Daniel Butler, who will be giving us an overview of key themes that are facing financial institutions. Daniel, are you there?
I certainly am, Doreen. Thank you very much for hosting today, and it's a pleasure to be here on behalf of the Aon team. So thank you very much, and thank you for everybody who's dialed in to listen to us today. So hopefully, as you said, it'll be a very good session. As you may be aware, Aon, in our business, we don't only just look at risk and insurance, but we also serve our clients in the areas of human capital, in retirement and pensions as well. And we serve the banking sector in all these areas, which really gives us deep insights into key themes facing the FI industry sector. For 2021, we summarized these into 4 buckets, being resilience, digitalization, non-financial tail risk, and balance sheet optimization. So I'm going to give you a brief overview of each of these, but our overarching message today is that we, as Doreen says, we live in an increasingly competitive, volatile environment. This presents both an opportunity and a threat. And then we see banks who are embracing latest techniques in risk and people management are likely to be the ones that benefit. So a comprehensive strategy which harnesses best practice across all disciplines will be critical for continued success. Have the next slide, please. So in terms of resilience, financial institutions all over the world are under pressure to prove resiliency. Regulators are constantly challenging banks to demonstrate their own financial resiliencies. In the UK, the Prudential Regulatory Authority defines operational resiliency as the ability of firms and the financial sector as a whole to prevent, adapt, respond to, recover, and learn from operational disruptions. I think it's fair to say that most banks have coped well in terms of their reaction to the pandemic. Indeed, whereas the banking community were often cited as the cause of the financial crisis in 2008, this time, many banks are seeing this as an opportunity to really be part of the solution. But the changing business model with working from home is bringing new pressures on risk management. Probably the single biggest threat to banks in terms of maintaining resiliencies comes from cyber attacks. Yesterday, for example, we heard in a meeting with the AIF that the cost of network attacks to the business sector was approximately $6 trillion over the last 12 months, with global investment in defenses of approximately 160 billion. This delta shows the challenges facing the financial community and the increasing threat, which is why today we're going to focus very much around the cyber risk management piece in terms of the next section. In terms of digitalization, Digitalisation is impacting service delivery, working practices, and creating new risks that need to be identified, quantified, and managed. Digitalisation is an excellent example of being both an opportunity and a threat. We heard from one of the leading globally active banks recently, who went on record as stating their 5-year plan for digitalisation was accelerated in a matter of months thanks to the COVID pandemic. So what COVID is doing is it's accelerating the trends that are already happening, which presents, as I said earlier, both an opportunity and a threat. Manual processes are dissolving as automation evolves, and there'll be a need to reskill the workforce as part of the transition into digitalisation. We're also seeing digital payments continue to grow, demanding appropriate controls to manage new risks and exposures. Digital assets and cryptocurrencies will also continue to change the way financial institutions trade. We see this as a strategically important area to invest in to support our clients in managing volatility in this area, both from financial risk as well as a human capital perspective. And an interesting statistic here was 779 billion there were worldwide trades last year alone in this sector. Come to the next slide, please. So, in terms of tail risk, a key outcome of COVID-19 has been that senior management in banks are really embracing the need to focus on tail risk. So what do we mean by tail risk? We refer to non-financial risk examples. The primary example is cyber, which we've mentioned already, and we're going to talk about today. But in addition to cyber, there are 3 other areas I wanted to highlight to you today. First of all, crime. So both internal and external fraud exposure is heightening due to the pandemic. We're seeing examples where, for example, older people are being forced onto online banking, and the fraudsters are targeting these people who are more vulnerable. We're also seeing exposures around conduct. This often lags crime and cyber, but changes in working practices and pressure on processes tend to lead to increase in numbers of violations and increased litigation. The Financial Stability Board estimates that the fines and compensation paid from the period from 2007 for misconduct exceeded $320 billion. As Mark Carney said, the resources that could have supported up to $5 trillion in lending. This is a staggering number and demonstrates the need for banks to rapidly evolve and adapt sound risk management practices, or the potential pitfalls later are stark. And the final area is around execution risk. One of the concerns here, a key concern here, is banking exposure to third parties. So banks need to avoid concentration and dependencies and manage their third-party liability with great focus. And the last statistic here, which I would like to share, is the fact that 90%, over 90% of operational risk losses are caused by people. This came from our data and demonstrates the importance of focusing on people risk management in terms of managing tail risk in an effective manner. Can I have the next slide, please? So finally, the fourth pillar of issues that we've seen today is around building balance sheet resilience. Banks are operating in a competitive environment, and we're seeing more and more focus on ways to seek external sources of capital to help de-risk balance sheets. 2 areas to highlight are retirement and credit, areas where both areas here we're seeing the opportunity for banks to deleverage some of their risk exposure into the insurance markets. However, a key part of supporting balance sheet resiliency is to have a sound risk management strategy backed by a solid insurance strategy. And this is going to be the focus of our conversation today. And on that note, I'm going to hand over to Justin, who is going to take you through the cybersecurity risk and insurance capabilities.
Thank you, Daniel. First of all, I just wanted to kind of highlight some of the cybersecurity kind of risk and insurance areas where Aon globally are involved, because I think this is an area where people are not necessarily that familiar with the kinds of things that we do here. And this informs our thinking about how we look at cyber risk and cyber security risk exposure across the business here. And I think, especially wanted to kind of just not only draw on the fact that we are informed by our experience around being a cyber insurance broker, but we're also informed around, both significant amounts of assessment, quantification work, as well as being a leading, high-profile incident response breach, provider. So that comes in via, acquisition. Back in 2016, Aon did acquire a international digital forensics and incident response company called Stroz Friedberg. And through that, Aon has brought in the capability that has effectively handled 12 of the largest 20 breaches. So we're informed by all of those different streams as to how we look at cybersecurity risk. And that's informed the model that we like to kind of fit this to and look as a viewpoint through. So we look at managing the total cost of cybersecurity risk through a model we call the cyber loop. And the cyber loop it's an assumption that an organization is going to be embarking on or looking to improve its cybersecurity risk exposure in a number of different ways. And certainly, an organization may enter at any one of the different areas that we're talking about here. And we break them down into the 4 different areas we have here: assessment, quantification, insurance or risk transfer, and then also incident response readiness. And it's this kind of simplified but rather kind of powerful model of how we look at how an organization may look to do a sea change kind of improvement around how they manage cybersecurity risk, but also looking to really capture multiple areas of related parts of the cybersecurity risk picture. And I'm going to just dive into a couple of different areas, and then I'll hand off to my colleagues for the rest of these areas. But this informs kind of how we look at cybersecurity risk across Aon itself. I will note that there is actually a white paper on this which goes into significantly more detail if people are interested. But I'm really just going to touch upon this because this is a fundamental way that we think about how an organization really should look at how they're doing these things and perhaps identify additional areas where focus should be put. Can you go to the next slide, please? The first one I'm going to look at is assessment. So there's an assumption here that either we've entered the cyber loop at this point, or perhaps we're moving around the cyber loop. Maybe we've done something else before. Perhaps we've bought cyber insurance, and then we've embarked on assessment after that. Perhaps assessment is tied to a regulatory requirement. But whatever form of cyber security assessment you're doing, that is certainly kind of a key risk measurement, risk management kind of task here. I mean, one of the things that I'll highlight here, this is just one of our various things that we do in this area, is we have a assessment platform called PsyQ. And part of PsyQ is we're actually collecting data from practices across organizations across the world. And we use that to inform ourselves around large data sets of general practice and things like that as well. But the important thing here is that one of the entry points to the cyber loop is assessing your current posture, assessing your current maturity against whatever standard it happens to be, against whatever benchmark it happens to be, perhaps against your peers as well, and then potentially looking to move to another area of the cyber loop and improve practice there as well. Can you go to the next slide, please? Other types of assessment which might be here, we might also talk about, I touched on maturity assessments, doing cybersecurity risk assessments against something like NIST or against ISO 27001, but also things like, for example, we talk about incident response, doing tabletop exercises of seeing your crisis response, could fit into assessment, doing live exercises. Certainly there's regulatory cyber stress testing programs which have come out in various parts of the world. There's ones of these in the European Union, the ECB scheme, TIBA. There's the Bank of England scheme, CBEST. There's the Hong Kong Monetary Authority scheme, ICAST. These are all live cyber stress testing events where a provider such as ourselves, Aon is one of our services that we do, actually hacks you. So looks to breach your defenses, looks to gain access to kind of targets that you've defined to see effectively how well your capability is to respond to an actual live breach scenario. So all of these kinds of things are the types of things which would fit within assessment. If we move on to the next slide, please. And then touching upon another one of the cyber loop, I'm going to leave quantification and insurance to my colleagues who follow me in this. Another one of the entry points that we could either enter at or we could move around the cyber loop to is incident response readiness. So we talked about, the previous one was assessment, which was kind of looking at, your current posture, how well you're prepared, your readiness. The incident response readiness is really looking at kind of your capability to respond to a breach. So that's, do you have the appropriate measures and relationships in place? Have you tested those plans? Have you actually done exercises of those, and the relevant stakeholders within the business are, for example, aware of the kinds of decisions that they would need to make in these kinds of scenarios. But also things like, for example, what if a critical decision maker is on a plane for 12 hours when a breach happens? Who can make those kinds of decisions in a crisis scenario due to a cyber breach? And are they aware of those kinds of things? And better still, as I mentioned, have you exercised those? Because these kinds of scenarios in real life are not ones where the people making the decisions are probably going to be operating at their best due to the stress, due to the pressure. So definitely exercising these kinds of things ahead of time and being prepared for these kinds of things is a key part of this as well. And at this point, I believe, Paul, it's time to hand off to you to talk about some more things about the cyber loop.
Great, thank you, Justin, and hi, everybody. So obviously, Justin introduced the concept of the cyber loop and explained how that's the framework through which we help all of our clients to understand and mitigate against and improve their cyber risk security posture and make sure they have the right insurance in place. And one of the key elements of this is quantification. So understanding how much a cyber event could cost the business if one were to happen. So the framework we used for this is something that we call cyber impact analysis. So cyber impact analysis is Aon's framework for helping clients understand the drivers of their cyber risk exposure and quantifying the potential cost of cyber events. We successfully used this approach to help hundreds of clients across all major industries better understand their risk so they can put in place better risk management controls and secure the optimal insurance coverage for the residual risk left after those controls. When I say optimal insurance, I mean things like terms and conditions of the policies and the gaps in coverage provided by other policies, for example, crime and liability policies that the bank might already have in place. And ultimately to ensure that the insurance limits that are in place are consistent with both the risk appetite and also the risk exposure. So our approach has three elements. The first of these is scenario analysis. We work with clients' subject matter experts to identify the critical assets that are exposed to cyber risk. We also identify the threat actors who might attack them and the method that they might use to carry out these attacks. We base this on our knowledge of previous cyber events. We work with our security teams to make sure that we're up to date with the latest methods and techniques that are used by cyber criminals. Once we've identified these scenarios, the next stage is financial modeling. We quantify potential plausible adverse case losses for each of the identified scenarios using a wide range of data, such as Aon's own proprietary data, external data, and market benchmarks, and also the experience that we've gained through working with many clients on similar analyses. The last stage of the approach is stress testing. So we compare the cost calculated for each of the scenarios with the coverage that the client currently has and the coverage that would be provided by a standalone cyber insurance policy. What this allows us to do is identify areas where coverage is already available and gaps that a cyber insurance policy would likely cover. Using this analysis, we can help clients to ensure that they have the right portfolio of policies to ensure that their material risk exposures are adequately covered. So there are a number of key outcomes to this analysis. So the first one is a better understanding of the financial exposure from cyber risk. Helps you to identify the economic value of a policy, i.e. the cost versus the benefit of it. It informs decision making on the appropriate level of insurance limit, which could be very difficult for companies to understand without this sort of quantification happening first. And finally, it enhances board understanding of the shareholder value at risk associated with cyber insurance profile. This approach is about more than just insurance. It's about understanding where the risk exists, how you can better control it, and what it might cost if things would go wrong. So on the next slide, I'll talk about the scenario analysis process in a bit more detail. So we use the bow tie method for identifying and quantifying scenarios. This is a well-known approach within enterprise risk management that I'm sure many of you are familiar with.
The first thing we do is identify the business's critical technology asset. It could be data, it could be systems. We then I think about the types of cyber events that can compromise these assets. That could be hackers, it could be system failures, it could be any of those sorts of things. Once you've identified those things, the crown jewels of the business, we then work with the team and with our own security team to identify the threat actors who could attack these assets, the methods they could use to attack them, and the controls that are in place in the business already to try and limit the likelihood of such an event. Because it's important to factor in the controls that already exist to make sure that we're only looking at things that are plausible, but it's also important to identify where those controls perhaps could be bypassed by attackers and perhaps where the company can improve those controls. The final thing we do once we've identified all of those things is we identify the commercial impact of the event. So i.e., what are the areas of cost that the business could incur? And I'll talk about those in a minute. We also talk about the mitigant controls that are in place, because of course, once the event has happened, there are controls that are in place that will help the business identify and control the event quicker and therefore hopefully minimize the cost. So on the next slide, we'll look at the impact, some of these commercial impacts. So we break these into two categories. So essentially we have first-party impacts and we look at third-party impacts. We do this at a very granular level because the point of this process is to help clients to understand not just the total size of any potential loss, but how it would break down across the business. This is important for a number of reasons because different controls, both preventative and mitigant that are in place, will have different effects on different of these controls. It's also important, as we'll see in a moment, for working out where your current insurance program, different policies will provide coverage, and where you have gaps that a cyber insurance policy would cover. From the first party angle, we look at three buckets. So the first one is incident response. So what resources are we deploying to remediate the situation? So we're getting forensic accountants and qualified incident responders in to identify what has happened and how we can start to remedy it. There will also be potentially extra expenses and increased costs of working. So what additional resources is a business deploying to help mitigate the disruption? And finally, there can often be a revenue impact or a business interruption cost, particularly with a system outage. If things have to be shut down and the business can't operate as normal, what are the costs associated with that? And to specifically, what controls can we put in place to make that as short as possible? And what insurance do we need to have in place to try and manage the bottom line input that back to the company? From a third party or longer term view, we look at the third party liabilities. So what third party liability costs does the bank potentially have incurred that it would have to pay to others? What legal expenses can have been incurred or will be incurred that can potentially be pretty significant? And finally, and this is particularly acute for banks and other financial institutions, what regulatory expenses might there be? So that could be fines imposed, and it could be the costs of hosting and complying with regulatory investigations. And the final stage on the next slide is looking at how we bring all this together into quantification. So once we've identified the scenarios and once we've identified the commercial impacts, we put numbers on the plausible adverse costs of these losses. Now, this isn't to say that this is what a typical event would cost. It's also not to say this is what the maximum that you could ever be incurred from one of these events. We're trying to come up with what the termed an estimated maximum loss. So those of you who are familiar with thinking about property insurance, it's a similar term used to there. What's sort of plausible adverse loss that we could incur, taking into account controls we have in place and the exposure of the bank? So as you can see in this example, we quantify this for each of the different scenarios we've identified, and we give the exact numbers for each of the different cost categories. So as you can see straight away, the cost categories between different scenarios vary wildly. Some scenarios, such as denial of access or a system failure, will largely be business interruption related. Some that are data breach or disclosure of personally identifiable information, the cost will largely be incident response and regulatory fines. Now that will depend on the business, it will depend on the number of customers, it will depend on the systems, it will depend on the country, because obviously the regulatory environments are different in different places. So there's no one size fits all approach to this, but what we do is we take the data we have internally, we take the data we have externally licensed data and publicly available information, and we take the lessons that we've learned from doing hundreds of these examples with previous clients. We bring that all together with the knowledge from your internal subject matter experts to try and understand how events of this nature would impact your business. So that helps you get a better understanding of not only where the losses could happen, what assets would be affected and how they might be affected, but also what the cost could be if such a thing were to come to pass. And then on the next slide, the final section of our analysis is the stress testing of the insurance program. You can see in this example here what we've done. down the left-hand side, we've got all the different types of risks and all the different costs that we've looked at. And then from left to right, we have the different policies that this client had in place. So you can see that this client has a wide variety of policies: property, crime, K&R, professional indemnity, and some of the costs that we have identified would be covered or would potentially be covered under some of those policies, providing there are no explicit exclusions. So we would look at your additional policies. We'd work with our broking colleagues to make sure that the wording of your policies either includes or affirmatively excludes cyber risk. Then finally, we'll look at what a hypothetical cyber program would cover. Now, clearly, cyber programs are designed to cover these exact types of risks. There may be some overlaps with existing policies that can be tweaked in terms of the wording. And there may be places that actually, unfortunately, cyber cannot provide cover. But the purpose of this is to help you understand at a portfolio level what cover you already have, what gaps there are in the cover, what level of cover you need to make sure you have from a hypothetical future cyber policy to make sure that the risks that we've identified and the losses that we've identified are covered to a degree that is consistent with your business's risk appetite. And with that, I'm going to hand over to Dwayne, who's going to share some insights on the cyber insurance market.
Cyber markets have experienced a significant increase in claims, which has been driven primarily by ransomware. However, the business interruption elements and also liability associated with a cyber event contribute significantly to the total cost of a claim in our experience thus far. The nature of the ever-increasing cyber attacks means that there is an increase in combination attacks that result in multiple insuring clauses being triggered from a single event across both cyber and FI policies. In relation to this, we have also seen multiple examples globally of FIs having significant business interruption events due to both the events in their own network and also at service providers that ultimately affect day-to-day operations and also your client's ability to access funds. As a result, markets are generally narrowing coverage and reducing the capacity they are willing to offer on an individual risk basis. However, on all but the largest towers, we are able to renew expiring limits. Pricing on risks has steadily been increasing, and while the slide refers to a baseline increase of around 20% at the start of 2021, we are already seeing increases of anywhere up to 50%, depending on underwriters' view of the risk profile and cyber maturity of the client. However, with this in mind, we have seen that those risks that can differentiate themselves and have robust cyber maturity, they can evidence will see a better response from underwriters. Reviewing retentions that you're willing to take and trying to take some of the additional losses out of placement can also help. This would effectively turn some of the larger placements into more of a cat loss program and could be applicable for larger clients. Underwriters are reviewing risk and presentations with ever more scrutiny. And so with the amount of information being required has increased, we have seen a lighter touch approach to renewals in the past. We are now seeing that every renewal is being reviewed and more detailed questions being asked on every account. While it's an area that cannot be overlooked when presenting your risk and should be focused on most definitely, it is also important to present the depths of your defences, as this is an area that we will assist you in navigating, both from a consultancy perspective and also our go-to-market strategy. Key areas for underwriters when reviewing FIs for a standalone cyber policy are, if the worst happens, what are your backup and recovery capabilities, with particular interest being paid to what offline and immutable backups are in place, third-party risk management and how vendors access your systems, are there single sources of services within your IT infrastructure, what defences have been put in place to prevent lateral movement within a network and how your segmentation strategy provides this protection, and multiple others. Taking all this into consideration, I cannot stress enough that preparation is the key. With that, I'll now pass over to Adam and Lizzie to talk more about the traditional lines for client.
Thanks, Dwayne. So banks belong to the most secure institutions in the world, but despite constant vigilance, things can often go wrong and the operational risks of banks are great. During the day-to-day workings, some things can go wrong in different places because of bad faith clients, a fraudulent employee, someone neglecting their duty of care, or simply by giving incorrect advice. Institutions should seek to protect themselves against these risks as best as they can. Today, I'm going to give a high-level overview of the three products you can see on the slide, starting with Directors and Officers Liability. Directors and Officers Liability Insurance is liability insurance designed to protect the director's personal assets against personal liabilities of being a director. The policy is intended to provide protection for the financial impact of claims which may arise from allegations of wrongful acts committed by directors or officers in relation to decisions and actions taken within the scope of a director's regular corporate duties. Cover is extended for people actually performing the role of a D&O, regardless of their title, and it's extended to past, present, and future directors and officers, along with other senior employees whilst acting in a managerial capacity. To provide a little more context, an example of a D&O claim is a claim that happened back in 2014 with a UK public listed company, whereby they overstated their profits within their financials and annual report. A correction to the profit figures was shown on the company's September trading update, which sparked a chain of events with the share price dropping significantly as performance levels were significantly worse than previously reported. This led to a class action being brought by shareholders, along with a regulatory investigation, and there were also allegations of fraud, abuse of position and false accounting against directors, which resulted in a criminal investigation against the directors and officers. The outcome was a fine to the company of £129 million, along with directors and officers having to defend their positions in court and incurring high legal fees. Moving on to the second product, you can see we have civil liability. So often also referred to as professional indemnity. Financial institutions have professionals dealing with factors beyond their control and in an increasingly litigious society. The scope for errors and omissions to arise is heightened, often resulting in institutions finding themselves engaging in complex, lengthy and expensive legal battles. The civil liability policy is intended to provide coverage for such claims where a third party seeks to hold the institution legally liable, alleging a failure to perform or provide professional services. The civil liability policy therefore affords coverage for the defence costs and the legal fees incurred to appoint suitable counsel, along with covering any damages, settlements or awards awarded by a court. And lastly, we look at crime. So this is often also referred to as bankers' blanket bonds, or BBB. The crime policy is designed to cover institutions' direct financial loss sustained as a result of a fraudulent act. The policy provides coverage for a broad range of risks through both physical and non-physical crime, such as losses sustained by the bank due to internal fraud, so employee dishonesty. It's estimated that around 70% of all crime losses are to financial institutions involve an employee. Furthermore, it extends to losses sustained by the bank as a result of a fraudulent act and or dishonest act committed using computers, either by employees, outsiders, or both in collusion. It then extends to include coverage for property or funds resulting from theft, unexplained disappearance, damage, destruction, or misplacement, both on the premises of the insured or off the premises of the insured, such as in ATMs, whilst in transit. And then finally, coverage can also be extended to cover situations where the bank have acted or relied upon forged or fraudulently altered checks, bills of exchange, drafts, acceptances, withdrawal orders, certificates of deposit, letters of credit, and money orders, along with forged securities and counterfeit currency. As you can appreciate, this is not an in-depth analysis at all. This is intended to provide a high-level overview, and we'd be happy to provide further details and more in-depth discussions should this be of interest. I'll hand over to Lizzie.
Thank you, Adam. I will go on to tell you a little bit about the wider market environment we are operating in and strategies to differentiate your risk at renewal for these lines of business. So as some of you will know, having recently renewed or interacted with the market in some way regarding these products, it is still a picture of rising prices and shrinking capacity. Increased claims activity for these product lines, along with years of low premiums and low deductibles, have resulted in poor results for insurers. So senior management across the board are reviewing their existing portfolios and enacting a change in strategy. Mainly, this involves reducing lines, but increasing premiums and increasing retention levels, along with being much more selective. We therefore, notwithstanding everything that happened last year, already knew 2020 wasn't going to be straightforward. And as Daniel touched on with respect to risk dynamics, compounding this situation and catalyzing this existing process is the COVID-19 pandemic. In an early estimate, Lloyds has suggested that COVID-19 could be the market's largest ever single loss event, estimating a total projected loss to the industry, the whole industry, from claims and fallen investment portfolios of around $203 billion. This immediate impact on capital has, of course, been exacerbated by wider economic uncertainty. And in terms of the financial lines market specifically, we have seen a variance in underwriters' responses, from reducing capacity across certain lines and programs, yet further right through to exiting complete sectors by geography or industry, for example. But really, all insurers have reacted in some way. Now, that said, it's not all bad news, as new or newer entrants to the market see an opportunity here. There are two sides to every story, and for those without the long tail claims or the legacy exposure, there is certainly the willingness and the scope to grow in partnership with clients. There was a significant disruption, for example, in Q3 last year when AXA XL closed their London financial lines platform, and we have found other markets picking up those lines on programs. So of course, while portfolio closures are outside of Aon or a broker's control, we are in constant and open dialogue with all trading partners around profitability and resilience in the current market, so we can ensure sustainable relationships as much as possible with clients. Bearing in mind that this trading environment, the message is clear. As the market becomes more selective, organizations must proactively take control of their risk financing approach and renewal process. So how to navigate this process and how to differentiate your renewal in this market? Firstly, preparation for renewal is crucial. We would always be advising allowing plenty of time for the pre-renewal process. At least 3 months really, allowing sufficient time for your broker and your partner in this process to gain a full and complete understanding of your business, your insurance requirements, and your priorities. It is important to spend this time working with your broker to really understand your specific risk appetite and manage the risk transfer process with the best go-to-market strategy. So emerging is key is choosing the right broker for you with the skill set, the resources, and the capabilities to deliver a successful outcome in line very much with your business's risk management objectives. And investing in this relationship, and very importantly, actually, that with key reinsurers, is ultimately the strategy that is proving to be the most effective during what we know are turbulent and challenging times. Establishing long-term partnerships with specific insurers builds a stronger understanding of your risk profile, multiple years of premium with a carrier, and trust over the years. Bearing in mind some of the market dynamics we've touched on today, it is really this approach that can smooth those large fluctuations in premium levels following a claim, for example. And speaking of claims, as we've heard today about some of the risks and pressures facing risk management at banks, consideration of the coverage actually afforded by an insurance product may seem obvious, but is key. Essentially, the most price competitive solution is not always the best. Fundamentally, the product has to work in meeting your needs and be suitable for your own risk profile. When presented with quotes, it is a combination, yes, of price and breadth of coverage, as well as adequacy and financial rating and the strength of the underlying security that should be considered. So when approaching the market and obtaining quotes, finally, presenting a full and detailed submission is what will deliver the best product and best price available. For these product lines, you can see here what are the core components necessary for the market to build an accurate picture of your specific risk profile. Alongside increased submission flows in recent years, the underwriting process itself has fallen into a much more rigorous committee-based approach. Underwriters have maintained emphasis, yes, on their core underwriting factors, but also put greater focus on business resilience, environmental, social, and governance performance issues. So differentiating your risk in this marketplace largely comes down to providing information around these points that highlights positive differentiators in a timely and therefore sensitive presentation of your risk. So essentially, clients who have had the most success navigating this hard market have been those who have moved away from a more procurement-based approach and engaged holistically with risk, with the total cost of risk in its entirety, making informed buying decisions based on price, the quality of the product, and the quality of the service that goes alongside that. I would now like to hand over to Doreen and Daniel, who will open up this webinar for questions.
Okay, thank you so much to all our panelists today. We still have a few minutes and we'll take questions coming in from our attendees. Please raise your hand if you'd like to ask something, and our technical team will open up the floor and we'll allow you to ask. Yes, Maurice, please, Timothy, would you kindly open the floor for Maurice to ask his question?
Sometimes we have global banks that have subsidiaries operating in various parts of Africa, and the deductibles or excesses are normally quite massive. In some instances, you could get deductibles as high as $1 million, some as high as $5 million. Of course, some of these then are then covered through captives, or in other cases, these eventually probably written on the balance sheets of some of these local subsidiaries. For those local subsidiaries, these excesses are massive and could wipe out the capital of those subsidiaries. Do we have a secondary market that can provide coverage for these deductibles and excesses, knowing very well that despite all risk mitigations, despite all the processes that are together for all these organizations, risks are imminent and sometimes losses do occur. So at the end of the day, these particular subsidiaries still need protection despite the structured global program in place. Thank you.
So I think this is where it's important to start the process very early, so that we, as your partner and your broker, can work with you to understand your requirements, understand what is going to be acceptable for your, for the institution and the subsidiaries in terms of deductible levels. However, I will caveat that with the fact that low deductibles are really something that the market are looking to address as a whole. And I think realistically, the deductible level is largely going to be set by and influenced by the claims history of the institution. So, there's a number of different factors here to consider. And I think this is just something that needs to be addressed early in the process, identified, discussed with insurers, and to pick a key partner that understands your business, has the time prior to your renewal to invest and understand your business as well, and then help to structure a solution that is suitable for you. So, often what we found in the past is, only being contacted 2 or 3 days before the renewal insets or expires, which doesn't allow sufficient time to have these conversations or to carry out a thorough job.
Okay, thank you so much, Adam. Manfred Sibande, you have a question. Please unmute yourself.
In the wake of COVID-19, how have the BI, business interruption, and DNO played out in the London market? Have insurers experienced litigation against them? And what are the losses?
I think from a business interruption insurance standpoint, there has been a case, you're probably alluding to the recent UK Supreme Court ruling brought by the FCA, and there is obviously a lot of commentary around that available. Business interruption is a very different product to the ones we've been talking about today. We would of course expect a pandemic like what we have experienced to result in claims, and all these insurance products are very complex and very technical, and coverage disputes are not uncommon. So I think still following the progress of that, this is still very much a process that's ongoing. Identifying coverage on your existing policy, all policies are very, very different. It's very case by case specific. Thank you.
Okay, thank you so much. There's a question from Richard. He's asking, does cyber policy cover you globally or excludes data theft or loss that occurs outside national borders?
So yeah, most definitely cyber policies can be placed for global entities. You know, cyber isn't really territorially restricted, right? So technology and networks are connected all over the planet. Data might not, if you hold it in the cloud, it might not necessarily be within your territorial borders. So we generally try to place all of ours on a worldwide ex-US or a worldwide global basis.
Gilbert is asking, what does it take to have a cyber policy that covers both direct and indirect risks?
Yeah, well, I can take that one again as well. That's not a problem. It's a bit of a difficult one because it really depends on how we define direct and indirect risks. So if we mean malicious attacks directly against your networks or maybe your actual service providers, but then, you know, and that's direct. But then if we have an indirect effect, so something like, say, a NotPetya or a wild virus out there, some policies can cover both, and we generally don't split them by malicious nature against your own systems and not. However, it really is specifically on the terms and conditions of the policy, and that's what we'd work with any of our clients with to make sure they understood exactly what they purchased.
Okay, thank you so much, Dwayne. We'd like to close this. We'd like to thank all the panelists and all the attendees, and we hope that you found this session very insightful and it will help you rethink, you know, risk management to improve for your organizations. Thank you so much. We'd like to wish you a good day. Thank you from the team at Minet and the team at Aon. Have a lovely day. Thank you.